This week's been a good week for markets, and clients generally have been asking us where we see markets and how long this cycle can last. Key thing for us has been that we're now in a period where we've got fiscal stimulus at a point of full employment. That means that we've moved from a deflationary environment to an inflationary environment, which likely changes the way this cycle will end. This week we've seen strong economic data with acceleration of Fed interest rate rises and the probability of that. We've also seen a really successful tech IPO in Snap. So what are the determinants of how long this market cycle will last? We think there are around 6. Firstly, Trump policy and the effectiveness of implementing that. Secondly, where bond yields go from here and how quickly they rise to shut off growth in the cycle. Thirdly, what the Fed does in terms of their interest rate policy and whether they offset the fiscal stimulus that we're seeing. Fourthly, whether inflation does pick up meaningfully and we get wage inflation coming through into the more general economy. Fifthly, whether we have any external shocks that slow global GDP. And finally, whether markets get too exuberant and therefore shut off investment opportunities. This backdrop is more akin to the 1990s than we've had for quite a long time. So in the 1990s, we were in a period where there was an acceptance of low inflation as the backdrop to environment. We had interest rates at around 4%. We had CPI running at around 2 to 3%. We had GDP running at 3%. We had unemployment falling towards 4%. So a very similar backdrop to where we are at the moment. The catalyst for markets that ended the cycle was an acceleration in productivity growth. So we went from 0.8% in '86 to 2.7% in 1990. And that growth rate was extrapolated by markets because of the tech boom that we were going through at the time and expectations of very rapid income per capita growth were started to be fed into decision making. So we saw consumers bringing forward income expenditure from future higher incomes, and we saw businesses investing in plant and machinery to take advantage of this greater productivity. As a result, we saw GDP rise in 1999, Q3 from 4.7% to 8.3% in Q4. And that led to the Fed raising rates more aggressively. So we had 3 rate rises in '99, then a further percentage point in 2000, which led to a slowing of corporate expansion and investment and an inventory liquidation. That led to unemployment in the manufacturing industry, which fed into the service industry, which led to a slowdown that was exacerbated by the amount of leverage in the system and the excessive equity financing that was in place. So GDP fell from 8.3 in that Q3 '99 to 1.3% in Q3 2000. Looking at where we are now, we don't think the data is telling us we're at the end of the cycle. Current GDP levels are around 2%, which is well below the point where the Fed would need to raise rates aggressively. Government bond yields are around 2.5% on the 10-year in the US, and again, we feel there's plenty of headroom for them to rise before equity markets are affected by those numbers. And finally, inflation has actually tailed off over the last few months. So we're not seeing that big pickup in inflation. Equity markets have gone up, but relative to bond markets and alternatives, they remain well priced in our view. Looking at the week ahead, on Tuesday we have Direct Line, we have Ashtead, we have McCarthy & Stone, and we have Vonovia. On Wednesday we've got Hill & Smith. On Thursday we've got Cineworld and Lind. And on Friday we've got eShore. Thanks very much.